Segment number one, I've named it Carl. It sounds kind of corny, but you know what? You'll see where we're going with it. Next. So Carl, the four factors that lenders use to qualify to finance a home. So we have credit score, ability to repay, reserves, and loan to value. Next. So credit score. Credit score for every mortgage that is done, and just like if you were to buy a car or buy anything under an installment plan, they need to run your credit. And credit is just something that they run with the three major credit bureaus, Equifax, Experian, and TransUnion. And what they utilize is they don't utilize your high or your low, they actually utilize your middle credit score. And if there's two borrowers on it, we use the low of middle score of one of the two. We can do mortgages down as low as 500, but you really want to try to get your mortgage, your credit score up as much as possible. All the programs that we're going to be looking at today are over 620, but you know what? We can still do mortgages as low as 500, but it will reduce the amount of products that are available, and also the rates would be higher. Next. Ability to repay. The ability to repay is a really important factor to a loan and what the lenders look at, because they really need to make sure that you have the ability to repay the loan. You know, they have laws, you know, after the 2008-2009 financial collapse, they really put through Dodd-Frank, they put a lot of measures in place to protect against predatory lending. And so the stated loans that were out there, where if you had a pulse, you could get a loan, they don't have those anymore. And so what this is to avoid predatory lending. What they utilize, and I'm going to start out with my first acronym for the day, and that's DTI, debt to income ratio. So where you want to stay at is under 50% DTI is what's preferred. So let me give you an example. So your debt is everything that's basically on your credit report. So your minimum payments, your mortgage, your taxes and insurance, all of that, you total that up and you come up with your debt. And then you divide that by your gross monthly income, not your net monthly income, but your gross monthly income. And so I have a little formula here at the bottom. So if your debt is $5,000 and your gross monthly income for the month is at $10,000, you're at 50% debt to income ratio, or DTI ratio. Now, the number 50% is just kind of a measure that I think that is a safe measure to go by. I've seen loans be qualified over 50%, but usually only a couple of clicks over. But usually if you go over 50%, we're not going to be able to approve the loan. But with credit unions, you know what? There are some compensating factors. There's high reserves or things like that. We'll go through that later. Next. Reserves. All right, reserves are used to show that you have money in case of a life event or emergency. And what I mean by that is life is in session. You know, we've seen so many changes in this last couple of years where things change for somebody's financial position. And so the lender wants to make sure that if something happens, such as a divorce, somebody gets sick, your child is sick, you have to go take care of your parents, separations, you know, a pandemic, you know, all these different things that happen can affect somebody's ability to make their house payment, you know, and we you know, lenders are not in the business to foreclose. They want to, you know, help people achieve their financial dream. And by doing that, they have certain things that are in place, and reserves is one of those. So your liquid assets, what is liquid assets? That's your checking, savings, IRA, bonds, anything that can be liquidated to help you make your house payment in the case of an emergency or a case of a life event happening. Usually 2 months worth of, here's another acronym, PITI, which is principal, interest, taxes, and insurance. Okay, what that is basically is all the parts of your mortgage payment. And so 2 months worth of that. So let's go ahead and give you an example. If your mortgage payment is $2,000, they're looking for you to have about $4,000 in liquid assets to make sure that if something does go wrong, that you have a fallback position. Next. Loan to value. This shows the loan versus equity in the property. Okay, so quick little look at it is 800,000. If your mortgage is 800,000 and your property is valued at a million, that means that you have an 80% loan to value. Just 800 divided by 1 million equals that 80%. So 80% loan to value with 20% of equity. The lower the loan to value, the more desirable it is to the investor. And what happens when they feel more comfortable is you get a better rate. So let me give you an example here. Is with a mortgage and the collateral that a lender needs to have to be able to do a mortgage, 20% is great. You know, if they have that, then if something happens or the market fluctuates, their investment in giving that loan is in pretty safe position, because generally only once in a very great while will you see the market move 20%. We saw it in 2008, but really you see it once every few decades. And so it's a pretty safe position. But if let's go ahead and say you're at a 70%, 60%, or a 50% loan to value, that means you have 50% equity and 50% worth of mortgage. That puts the lender in a very safe position, and they want to reward that by giving you a better rate and better pricing on your loan. Next. Okay, so what we're going to do is I went ahead and got some questions right out of the gates. And so wherever I saw the question being asked a couple of times, I wanted to list those so that we can address as many questions as possible. So question number one, what do I need to get the process started in getting financed for a home? Next. So the first thing I would do is I would call Cal State LAFCU or go to their website to fill out a quick application. But you also need to gather the following items. Now, what these items are, they can be used for two things. One is to get pre-qualified. Very important that if you're going to be looking and putting in bids for housing, you want to make sure that you have a pre-approval letter. A seller certainly would like to see the strongest position possible. So more money down, the stronger position. But also if they can see that you've already done your homework, that you've already got a pre-approval in hand with a lender that's saying they will do a loan for you, makes that a nice, strong offer to go in with. And so these items also would be used for your actual loan. These are the items that we need to be able to qualify you for a loan and to be able to execute the loan. And we could go and ask you for a few of these things and then go back and ask you for more. But I find the best thing to do is just give you the list. You can go ahead and come up with those. And that way, when you come in for a loan or a pre-approval, you're ready. You got everything that you need. So the first thing is copy of your driver's license. If there's more than one borrower, you want to have both driver's licenses. A real easy way to do it, what I find is, if you don't have a printer, if you don't have a color copier, just take a picture of it on your phone. And then when you go in, you can say, I can just go ahead and email this over to you from my phone. It's a nice color picture. It'll come over. It's pretty easy to do. Paycheck stubs. We need to have 1 month's worth. So if you have biweekly, you have 2 checks, or if it's, a monthly, you only have 1. We want to have the most recent paycheck stub or stubs for your employment. 2 years tax returns, most recent, all pages. All pages is very important. A lot of times you think just the first couple of pages on your tax return will do. You really need to have all pages, because when we send it into a lender or we send it into underwriting, they need to make sure they have all pages. We need 2 months worth of bank statements, all pages again, most recent. And then also, this is a piece that we really need to make sure we have too. It's 2 months worth of bank statements, sourcing the down payment, all pages. And now let me throw in a little caveat too, is if part of the down payment is borrowed from, say, a mom or a dad or a brother or something like that, you want to go ahead and get 2 months worth of bank statements from them, sourcing the funds that are coming in. And what that is it's part of the Patriot Act. It's just making sure that those funds are real. They're not brought in, or money's not being laundered to be able to buy a home. And so that's kind of where that condition comes from. And then 2 years worth of W-2s, most recent as well. Let's go to question number 2. How much are closing costs typically? Closing costs are one of those things where when you're buying your first home, you kind of forget that there's closing costs associated with getting your loan done. The first thing that I remember when I bought my first home, it was like I thought that, okay, I just got to come up with 20. At that time it was 20% down, and I got to do everything I can to make sure that I got the 20% down. And then the closing costs came in. It was an extra $4,000 in closing costs, and I was like, oh gosh, where am I going to find that? Of course, I called my dad. So this is one of those things that you got to be prepared for. So you have different amounts that you can put as a down payment, but you also have to make sure that you can cover the closing costs. Next. All right, so closing costs, what they are and how much they are. So closing costs are title, escrow, notary, recording fees, et cetera, et cetera. They typically run about 1% of the purchase price, under $1 million. This isn't an exact measure. You have different title companies, you have different escrows, you have different recording fees, different notaries, different underwriting fees, processing fees. All of these things change with every lender in every city. And but through all the transactions through the years, what I have found is that if you can prepare for about 1% of the purchase price, I think you'll be right in there. So on a $500,000 purchase, expect to spend about $5,000 in closing costs. Refinances are a little bit different. I'm sure you guys have heard advertisements all over the radio that say, we've got a 3.5% and APR. Well, the reason why they do that is because 3.5% is the rate. But when they say an APR, it's the cost associated with the closing costs that they wrap into the loan. And so that APR gets a little bit higher. And so with this, with a refinance, you're usually looking at $0 to about $3,500. It just depends on how much the lender is going to pay for the closing costs. Generally, the lender doesn't exactly pay for it. They give you a little bit higher rate than they need to cover those fees, because escrow and title and notaries and recording, all those things still have to be paid. It's just the way that it's paid. But since this is mostly for first-time home buyers, let's call it 1%. If your purchase is under $1 million, we'll keep you safe. Okay, let's go to segment 2.